Hello investors, it's been another good month for your portfolio, a month of outperformance. The portfolio has done from 7.5 to 8% range versus the benchmark, which is the Nifty 500, has done just north of 6%. So it's again been a good month, satisfying month, and more so the small cap index has been negative 2%. So we continue another month of outperformance. And the themes that we had invested in, which is specialty chemicals, underweight banks, overweight pharma, API plays, is playing out. And as the market is, it doesn't oblige you every month, but these are themes we were invested in, and fortunately they are playing out right now, and it's rewarding you and your portfolio. So it's been another good phase. The markets actually has been surprising everybody on the upside. We've crossed 17,000, and the thing on everyone's mind is that should we top up right now or wait for a correction? So this week our research team got into this gazing exercise as to, well, whenever markets actually move like this, how much further can they go? What is the price action after that? So this month we will look at what we expect to be the next phase of this bull market. So let me share with you a few slides. To sum it up, we have had two real major market crashes prior to the one in COVID. One was in 2000 when the whole IT bubble bust, and second was in 2008 when we had the financial crisis and the Lehman problem. So we went back and studied these two times when markets actually crashed vertically, and what was their price behavior. This time also, post-COVID, this was a third big crash. So we are trying to sort of withdraw patterns or have learnings from earlier market behaviors, because history is a big teacher, and trying to see as to how things can pan out. Hopefully sharing of this knowledge will help you to align your exposure to equities and to really answer the big question that, hey, should I add more to equities or should I wait for a correction? Because that's what's on the top of every mind. So let me share with you the first slide. What you see on your screen is the movement post the 2000 fall. So in the box on the top, you will see a pink color row which says 2000 to 2002. In 39 months, the market had a vertical fall. The Nifty fell 49%. However, post that, you will see in the blue arrow as well as the blue row, the Nifty had a vertical rise. In 9 months, it went up 119%. So whenever markets crash, they tend to shoot up very fast. It's like a spring that's compressed, and the moment it's released, that compression works the other way. So markets post a crash always move up vertically. So you will see that we are up 119% in 9 months. In the current up move, in the post-COVID, we are up about 120% plus. However, it's taken us 16 months. So this is not something new. This is a phenomena we see every time post crashes. The first leg of the bull market is very sharp. This is what I call the beaten down stock rally. In fact, the most beaten down stocks do the best. And the reflection is that in this up move, the small cap index has outperformed the large cap index by 2x. So this is what you are seeing right now is not the first time. It has happened in the past. It has happened post the IT crash. Markets have been up 119% in 9 months. However, post such a sharp move, the markets need to consolidate. So what we saw between 2004 and 2005, what you can see in the red row is for 15 months the market consolidated, and all the index did was a minus 6%. This is also shown by the gray circle that you can see. So after running so hard and so fast, the market needs to catch a breath, and it enters into a phase of consolidation. And post that, we have the third leg of the market, which is another bull market, which took a rally from 2005 to 2007. In 36 months, we were up 235%. So this is the representation of the three stages of the bull market. But you may say you're picking up a point in history. well, does it hold true all times? So let's go back to the next big crash that we had in 2008. So what you see on your screens is the bull market post the 2008 crash. Here again in the pink row, you will find that in 2008, the market in 14 months fell 65%. Mind you, this was a financial market crisis panic. But post that, in 2009, we had a 21-month vertical rise and the market went up 181%. So do not be fearful or phased of this bull market. We have had 16 to 17 months and we are up around 120 to 130%. So such pullbacks are very characteristic of what has happened in history. And we are exactly playing out like that. As I told you, this is a pullback rally of the most beaten down spaces. That is why you'll find sectors that were most underperforming for almost a decade actually do the best. And this has happened before. However, again, after running so fast, so hard, the market goes into a time-wise correction. Corrections can be two ways. One is price-wise and second is time-wise. And time-wise correction is nothing but the market taking a pause and catching a breath. And you realize that this went on for 35 months and the market was where it was almost 3 years later. But post that, we again had a bull market which took us all the way to 2020, and this is where we were before the fall in the COVID crash. So this is a representation of what has happened in the past. Markets post crashes come up sharply, and this is where we are right now. So we feel that, again, we are not calling for a top or anything of that sort, but it is very characteristic of markets or the indexes to not replicate what they did. If you are expecting that the market's up 100% last year, it's going to be up another 100%, no. What is most likely to happen is that they can be range bound, they can take some time, catch a breath, and that is a good thing to do, because if markets keep going up vertically, there's always a risk of a very sharp vertical fall. So this is really where we think we are positioned. We don't know whether it is 17,500, 18,000, 19,000, that only time will tell. But as an investor, what phase you will get into is hopefully a phase of consolidation where there will be little price volatility, but this will also be a point of immense opportunities. So now let us see how we are positioned at this point in time. Here you will see that in the fall, the COVID fall, it was very sharp. In 3 months we fell 40%. However, post that, this bull market, which started in April 2020, it's 17 months old, is up 128%. Where it will lead up to, we don't know. But however, we feel that this will be a phase of consolidation that may come in some periods to come. It's not a bad thing, it is a good thing. But you will ask yourself as an investor, and I ask myself as a fund manager, that if the index doesn't do well for a few months, then does it make sense to invest? So we took a further deep dive, and the research team got into actually looking at performances of sectors and stocks in a consolidation phase. And we were really surprised, because what we saw was that the markets, the index, the headline may have been flattish, but stocks inside had immense movements. In fact, stocks were up 50% and some stocks were down 50%. At an index level, the net effect is negligible, but there is still a lot of money to be made, and in case you're in the wrong phases, you can also lose a lot of money. So that was the real big understanding that we had. Then we started researching what were the characteristics of those winners and losers. And we realized that the singular point that the market played out or recognized in that consolidation phase is that stocks that have earnings continue to move up, and stocks that were just fairy tales and storytelling actually declined. In this euphoric stage, everything moves up. But when the market pauses, people start bifurcating between actual earnings versus storytelling. And that is why at Marathon now we are gravitating to a portfolio. We always has been in our philosophy, but the stocks that have good earnings, because we feel that even in a consolidating market, our portfolio will do well. As I tell you, that consolidating markets does not mean all stocks remain where they are. Good performers will get rewarded. And I just want to share with you that we have come out with quarterly numbers, we have updated your portfolio, and we realize that 90% of your portfolio has exhibited, demonstrated and come out with good numbers. So let me give you an update of your portfolio. What you will see on your screen are the 24 stocks. You will see that these are companies which you recognize, most of the names are high quality companies which have demonstrated good performance in sales and net profit on a 3-year CAGR basis. And mind you, the last 3 years have been challenging because you've had the effects of GST, you've had COVID. In spite of that phase, you can see in the pink column is the returns on equity. That means the return to the investor has been a healthy positive. So this gives you a sense of the kind of stocks that they are in your portfolio. And that is why we feel we are very well positioned that even if the markets go sideways, we will as investors be able to still make money. And that really comes to the question which was first raised, that should we wait for a correction or what? What should be a strategy? I think your strategy should, as an investor, should be to use this bull market to get out of stocks which are storytelling, which do not have earnings as their backbone, and move towards portfolios which you have seen earlier which have earnings, because portfolios will go up and down with markets. However, the net result post consolidation we have seen through history, through research, is that wherever there are earnings, those stocks will get rewarded. And that's the kind of portfolio we build for you at Marathon. And that is why we feel confident that markets may have a little bit of consolidation, may have a little bit of volatility, but your portfolio will do well. With that, I leave you for this month, and let's see what the future holds. Thank you.